Billions of dollars move through the stock market every day. But do you really know what drives these massive flows of capital? Forget everything you think you know about the stock market. Today, we're tearing down the curtain and exposing the truth behind stock prices. What you're about to learn could revolutionize your investment strategy and potentially save you from costly mistakes. Get ready to have your mind blown as we debunk the biggest myths of the stock market. Myth number 1. The stock market always reflects the economy. You've heard it 1,000 times. The stock market is tanking. The economy must be in trouble. But here's the shocker. They're not always in sync. Take 2020, for example. The global economy was reeling from lockdowns, yet the S&P 500 finished the year up 16%. Why? Because the market is forward-looking, often pricing in future expectations rather than current conditions. It saw beyond the immediate crisis to the potential for recovery and growth. Myth number 2. High-priced stocks are always better investments. Think a $1,000 stock is automatically better than a $10 stock. Think again. In 2020, Tesla's stock price soared past $2,000, prompting a 5-for-1 split. Did that make Tesla any less valuable? Absolutely not. On the flip side, Berkshire Hathaway's Class A shares trade for over $400,000 each, but that doesn't necessarily make them a better investment than Amazon at around $3,000. What matters is the company's fundamentals and growth potential, not the sticker price. Myth number 3. You need to time the market perfectly. If you're waiting for the perfect moment to invest, you might be waiting forever. Even legendary investors like Warren Buffett admit they can't time the market consistently. Consider this. If you had invested $10,000 in the S&P 500 at its peak just before the 2008 financial crisis, you'd still have over $30,000 by 2021, despite buying at the worst time. The key is time in the market, not timing the market. Myth number 4. News and analyst recommendations are always reliable. Remember when Elon Musk tweeted, "Tesla stock price is too high in my opinion" in 2020? The stock dropped 10% immediately, but ended the year up over 700%. Or consider the countless sell recommendations on Amazon over the years, while the stock has continued to climb. The lesson? By the time news hits the public, it's often already priced in. And analysts? They're human too, with their own biases and limitations. Myth number 5. Stock prices are driven purely by company performance. While earnings reports can cause stock prices to jump or plummet, they're not the whole story. Take the GameStop saga of 2021. The struggling retailer saw its stock skyrocket not because of improved performance, but due to a social media-driven short squeeze. Or consider how the entire tech sector often moves in tandem, regardless of individual company performance, due to broader market sentiment or macroeconomic factors. So what really drives stock prices? Supply and demand, the ultimate driver. When Porsche tried to acquire Volkswagen in 2008, it created artificial scarcity, briefly making VW the world's most valuable company. Company fundamentals. Apple's consistent growth in revenue and earnings has supported its long-term stock price appreciation. Future expectations. Amazon's stock price has often seemed disconnected from its profits because investors bet on its future potential. Market sentiment. The dot-com bubble of the late 1990s showed how irrational exuberance could drive prices to unsustainable levels. Macroeconomic factors. The Federal Reserve's interest rate decisions often cause market-wide movements, affecting stocks across the board. Industry trends. The shift towards renewable energy has boosted stocks like Tesla and NextEra Energy, while putting pressure on traditional oil companies. Global events. The COVID-19 pandemic caused a market crash in March 2020, followed by a tech-led boom as the world adapted to remote work and digital solutions. Understanding these drivers of stock prices is crucial for any investor. By debunking these myths, we've pulled back the curtain on what really moves the market. Remember, successful investing isn't about following the crowd or falling for sensational headlines. It's about understanding these underlying factors, doing your own research, and making informed decisions based on facts, not myths. If this video opened your eyes to the real drivers of stock prices, don't keep this knowledge to yourself. Like, subscribe, and share it with others who need to hear this. Together, we can build a community of informed, savvy investors. Until next time, happy investing.